Tom is right. Everyone who didn't believe in stock markets is wrong for the moment. But in the short term, there are so many questions left unanswered. Bad loans, unemployed, exactly what will happen to the economy. Can the rally be sustained?
I think there will be a pause for breath, but certainly I think that on a 12-month view, equities have materially further to run. If you wanted some point forecasts to prod me with in due course, I'd say that the S&P 500 can get to 3,800 points by the middle of the year next year, and 4,000 or 4,100 points by the end of next year. And that's based on what I'm projecting for corporate earnings per share, where the outlook is increasingly rosy, and the expectation, interestingly, that there'll be a modest compression of the price that investors are prepared to pay to participate in future profits growth. And underpinning all of this, of course, is the expectation that bond yields will stay low, that the Federal Reserve will remain accommodative, and Mr. Biden will spend some more money.
What if we don't get stimulus, James? What if you don't get stimulus in the US? And what if we see the weight of inflation 2021?
Well, there are two sorts of stimulus that we should think about. The first is whether or not we get further fiscal stimulus. And of course, we've not spent all of the money that was allocated in the CARES Act, passed into law by Team Trump on the 27th of March. That was $2.2 trillion, and not all of that has gone. And indeed, a lot of that money has ended up on household balance sheets where savings rates have risen. So it only actually requires the consumer to open their wallet, spend more in 2021, to see a positive tailwind for corporate earnings per share. There is then the issue of what happens with the Federal Reserve. I would suggest the Federal Reserve are likely to remain keen to remain easy because inflation does remain low for now. I absolutely accept that it will increase in due course, but for now, the Fed is exhibiting all of the signs that it is still caring about bond yields and therefore, by extension, equity prices.